Hey everyone, thanks for joining me again. Mark Rusin here, back for another video. Here we are over halfway through the month of October. And October has been one of the best months, at least for me personally, in terms of market gains. But this comes much needed considering the month of September was a brutal stretch of investing. The S&P 500 index is up 3% so far this month, but considering it was down almost 5% in the month of September, just this past month, that comes as a welcome sign for not only me, but many investors out there. Because 5% in a single month for an entire index is a pretty big fall. For those of you that follow me on social media, and if you don't, head over there and give me a follow as I'm putting out content every day. But if you do follow me, then you know that I love dividend investing. I have a personal goal to reach over $100,000 in passive income through dividends by the age of 60. And dividends are great because no matter what a stock price does, whether it goes up or down, you can bank on your dividends coming in as long as the company continues to perform over the years as expected. Now, in terms of that $100,000 goal, we are a long way from that. But I'm going to try and detail my journey here on YouTube for you to follow along and make any adjustments to your portfolio as you see needed as well. So in today's video, I'm going to give you 3 undervalued dividend stocks that I see out in the market right now. Make sure you stick around for the entire video because as I go through each of these 3 stocks, I'm going to go through what they do, what their valuations are, and take a look at their dividend stats both now and historically over the years. So if that interests you, without further ado, let's jump in. As always, everything shared on this video today is for educational and informational purposes only. Make sure you perform your due diligence before investing in any stock, especially one mentioned in any of these videos. Although I'm CPA, I am not a financial advisor. And before we take a look at these 3 stocks today, go down in the comments section down below and grab $30 free when you sign up for a new M1 Finance. Who doesn't love free money? And for those of you interested in cryptocurrency, I also dropped my BlockFi link down below where you can grab $10 free of crypto. As we go through the video today, let me know in the comments section down below if you own any of these. And also, give us a big like by hitting that thumbs up button down below, as that is huge for the growth of our channel moving forward as we continue to build this financial freedom community moving forward. And also, consider subscribing so you'll be notified anytime we drop new videos. The first undervalued dividend stock we're going to look at today is one of my favorites, and that is none other than AbbVie. Stock ticker ABBV. AbbVie shares are down nearly 10% since the start of September, and much of this has to do with the industry as a whole getting hit hard, as many in Congress are looking to crack down on drug prices. They're also looking to shorten the amount of time or the amount of challenges that these drug makers have to protect the patents that are on these drugs, which in essence would bring more biosimilars to the market in a quicker fashion. Often you will hear me refer to shares of AbbVie, or AbbVie in general, as the investor's trifecta. Now that's a shout out to any of you that are into the horse racing industry. As you know, a trifecta you need 3 components to hit. And with AbbVie, the 3 components are a high yield, dividend growth, and the potential for share growth, or price appreciation. For those of you unfamiliar with AbbVie, the company owns the #1 selling drug in the world in Humira. Now, a few years back, Humira lost patent protection, or the patent expired over in Europe, and have since seen the sales drop, as expected. Now, flash forward over here to the US, and Humira is expected to lose patent protection here in 2023. So this has been on investors' mind for a few years now, and management has been doing everything they can to diversify the portfolio. Now, a few years back, Humira accounted for nearly 65% of total revenues for the company. Everything was solely based on Humira for the most part. Since then, the company has built up a strong pipeline of their own products that are coming online. And they've also gone through the acquisition route, acquiring Botox maker Allergan, that closed last year for over $60 billion, which has added debt to the company, but it also adds more diversification in terms of products, which will further the company moving forward as Humira loses patent protection here in a few years. Now let's turn our attention to the dividend stats for AbbVie. The company currently pays an annual dividend of $1.30, which equates to a dividend yield of 4.8%. The company has a dividend payout ratio of only 41%, which allows for plenty of room for growth for the dividend moving forward. Speaking of dividend growth, AbbVie management has increased the dividend for 8 straight years with a 5-year average annual increase of 18%, which is incredible dividend growth. Over the past 12 months, shares of AbbVie are up nearly 30%. This speaks to the growth factor I mentioned when I spoke of AbbVie being an investor's trifecta. Capital appreciation, share growth. 30% in 12 months is spectacular growth, and that's exactly what AbbVie has done for investors over the past year. Not only that, they've given you a 4.5% dividend, plus they're raising their dividend over the past 5 years nearly 20%. Now, I don't expect that going forward, but with a forward valuation looking at next year's earnings, the company is trading at an insane valuation of only 7.75 times. This means you are only paying $7 for every dollar of earnings from the company. Whereas if you look at some other companies out there, you can see 30, 40, 50, over 100 times earnings. Now, these are high growth stocks, but like I had just mentioned with AbbVie, you're getting nearly 30% return in only 12 months. One thing you want to look at when investigating dividend stocks is free cash flow. You know, revenues are important, earnings are important, but free cash flow is where you dial up whether a dividend is safe or not. Free cash flow takes the income and backs out any of those accounting adjustments that you see in companies when looking at their 10Qs or 10Ks. This takes out depreciation and takes out the things like amortization. These are just those accounting things. They're not really cash movement. But with free cash flow, that's going to look at how much cash is coming in from an operating perspective and how much cash are we actually paying to run the business on a year or quarterly basis. And free cash flow is exactly where capital expenditures are paid and where the dividends are paid. So take a look at free cash flow when investigating a dividend stock and seeing if a dividend is safe in the coming years, because there's nothing worse than a cut dividend. The second undervalued dividend stock we're going to look at today is one of my favorites and one of the favorites across the dividend community. That is none other than Johnson & Johnson, stock ticker JNJ. Over the past month, shares of Johnson & Johnson are down 2.5%. But Johnson & Johnson is a resilient company, and it is one you will find in almost every dividend ETF out there. And in talking with dividend investors, Johnson & Johnson is a staple in almost every portfolio, or at least it should be. The company is about as consistent as they come, not only in terms of share appreciation, but in terms of performance as a company as a whole. When looking around your house, I would be shocked if you couldn't find 5 to 10 products minimum that are related to Johnson & Johnson. A few of their common products, or some of the most popular products, just to mention a couple, include Tylenol, Motrin, Band-Aid, Listerine, Neutrogena, Aveeno, and these are just a few to mention. If you go onto their website, there is a slew of products that you can see that you are for sure familiar with a good portion of them. Now, looking out a little bit further, shares of Johnson & Johnson are actually down over 11%. And a lot of this has to do with some negative press they've received lately in terms of a legal battle they're involved in with their talc powder that was in the Johnson & Johnson baby powder. They also, a few months prior to that, received negative news on their initial COVID vaccine, which was creating some blood clots and cramps and stuff like that. But that has since been dealt with and cleared, and they've actually received very positive reviews on their COVID booster shot. Next, let's take a look at some of the dividend stats for Johnson & Johnson. The company pays an annual dividend of $4.24, which equates to a dividend yield of 2.6%. The company has a dividend payout ratio of 44%, which again leaves plenty of room for management to increase the dividend moving forward. Johnson & Johnson is what is known as a dividend king, having increased their dividend for 59 consecutive years. That is impressive growth when it comes to dividend stocks out there. This means that they have increased it every single 12 months for 59 years. I just had to say that again, 59 years. That is quite an impressive feat, and they continue to move forward. Looking at forward valuation, shares of Johnson & Johnson trade at a forward price-to-earnings ratio of 15.3 times, which is well below their 5-year average of 17.7 times, representing a good opportunity to add a consistent and strong performer for dividends, not only for dividends, I should say, but for any consistent portfolio out there. This leads us to the third and final undervalued dividend stock, and that is 3M Company, stock ticker MMM. Over the past month, shares of 3M are roughly flat, or down 1.2%. But like Johnson & Johnson, 3M is a consistent holding that you will find in many dividend ETFs out there, and probably many dividend ETF or dividend investors' portfolios. Now, I would say Johnson & Johnson's probably a more common holding in many dividend portfolio or dividend investors, but 3M is right there with them. 3M is an industrial conglomerate, and here is just a few areas that 3M has products in. You can see that they have products from tape to glue to abrasives, coatings, really just a whole slew of things. And again, these are just a few of the areas that they have products in. Next, let's take a look at the company's dividend stats. The company currently pays an annual dividend of $5.92, which equates to a dividend yield of 3.3%. The company has a dividend payout ratio of 60%. And like we had mentioned with Johnson & Johnson, them being a dividend king, well, 3M takes it up another notch. The company has an impressive 63 consecutive years of dividend growth. Now, albeit the dividend growth has been a bit slower than either AbbVie or Johnson & Johnson, but nonetheless, 3M shareholders have received an average of 6.3% dividend increases over the past 5 years. Next, let's take a look at valuation. Shares of 3M on a forward-looking basis currently trade at a PE ratio of 17 times. Now this is below, again, their 5-year average of 20.6 times, suggesting now is a great time to add shares of 3M for the long term. And there you have it, 3 undervalued dividend-paying stocks. All 3 of these are strong companies with strong cash flows and plenty of room to increase their dividends in the coming years. Also, all 3 I have personally invested in over the past few months and will continue to do so on any further opportunities on pullbacks that we see in any of these 3 companies. And before we go, a fun thing that I like to do, especially on social media and get tons of comments on people enjoying it, is I'm going to show this graphic here, which will show you exactly how much dividend income you would get in year 1 if you invested $5,000 in each of these. So if you invest $5,000 in AbbVie, $5,000 in Johnson & Johnson, and $5,000 in 3M. And those figures there to the right will show you what your annual payment will be for each individual stock. And again, I hope you enjoyed the video, and if you haven't done so yet, please give us a like and also consider subscribing so you'll be notified anytime we drop new content. Take care, everyone, and we will see you next week.